Hello, friends. Welcome to the Weekend Investing DailyByte. Um, Markets in a fine mood today, although Nifty didn't move much, but the rest of the market made a comeback. So it's like a bounce that is happening now. Um, Whether this is a interim bottom or just a few days of bounce, we don't know yet. But nevertheless, any green on the screen uh, right now is more than welcome. I think we have had some really, I would say, a sequentially bad weeks, rather months. We are in the fifth down month. Now, this fifth down month, although we still have a good multiple sessions left for the month to go, uh, but if we do close February as well in red, this will be the first time since I think 1996 that the market has ever dropped 5 months in a row. There was a period prior to 96 where market did fall for even 8 months in a row. I think 94, 95 was that period. But 5 months in a row has not happened since 1996. Certainly it has not happened in the current century. So this is a big deal in terms of statistics. um, let's see where we end of February. I think we will have a green tick on the monthly candle at least by the end of the month. Let's dive in. Today, we are going to talk about a serial trap that most retail investors get into. Um, so, you can see the second half of the video if you just want to see that content. Initially, in the first half, we talk about the markets and how the sectors are performing. Please do read the disclaimer fully and do subscribe to the channel if you haven't so far. Let's now see the market. So markets Nifty actually jumping up, crossing two-day highs as well. You can see here, but then succumbing to pressures in the second half of the session and not closing above the two-day high. So this, as you would recall from my previous videos, I'm always looking for at least a two-day high close. So if Nifty had closed above the 2 days, the previous two candles, that would have given me more confidence that the market is wanting to move up just like here, perhaps. But that was not to be, at least for today. But nevertheless, last four sessions within a couple of hundred points of 23,000 is not something that is really so bad, given the fact that we are already down from 26,000 to 22,800, 22,900. Some bounce is always possible anytime. So Nifty closing absolutely flat for the day. Nifty Junior closing at two-day high, 1.1% up, looking good, almost as if we are starting off a new leg of this nature towards towards the averages. 64,500 remains the big pivot beyond which the confidence will certainly rise even more. Mid caps also up 1.5%. Very good rise from 17,900 just 2 days back to 18,600. It's a good rally. Beginning of of green shoots. Whether these green shoots will last or not, we will come to know only in a few days' time. Small caps also almost like a bullish engulfing, 2.25%. Very good recovery, aided mostly by stocks that have been hammered in the past, defense stocks and so on and so forth. Bank Nifty again closing a two-day high for sure, but very near now 50,000 again at the 40-day moving average as well. So Bank Nifty probably is the uh, stronger of all the indices that we have seen so far. Bank Nifty is well above the January lows also, which is not the case in other charts. So relatively, Bank Nifty is doing well. Gold up another 0.3% for the day. So we are closing in on 86,700 on gold. And gold, this kind of a move I haven't seen in a long time, where in less than 2 months we've gone from 74,000 to 80, nearly 87,000, almost touching 18% or so. Um, there is something happening in the gold market for sure. We'll find out as we go along. Market breadth. mm, Nifty absolutely flat. So Nifty was not demonstrating what the rest of the market was doing. Nifty Bank all green. Nifty mid cap 80% green. Nifty next 50 also green. Nifty 100, including which includes Nifty next 50 and Nifty 50, was sort of like two-thirds, one-thirds. Nifty 500 had 383 advances versus 114. So reasonably good breadth across the board for all the indices. In the heat maps, however, on the Nifty, you can see that IT stocks hammered badly. TCS, Infosys, Tech Mahindra, HCL Tech all down. Reliance was flat. Lever smashed down 2%. Bharti, Maruti, Mahindra, Sun Pharma, these were also down, and you only had some stocks like Axis Bank, L&T, BEL, HAL go up. Hindalco, Eicher Motors also up. In the Nifty Next 50 space, a lot more green. You have DLF, IRFC, PFC, Lodha, REC, Geofinance, Union Bank, JSW Energy, Torrent Pharma, Zomato, all doing quite well. LTIM, again in the IT space, was down. Adani, after this new probe and more details required by the US SEC, stocks were down for Adani Green, Adani Ensol, although other Adani stocks did not fall much. Sectoral trends, capital market stocks have cleared out whatever losses that were there for the last 1 week, 4.3% in just one session. Defense, after a smashing debut today, 4.2%. It has lost 25% in just 6 months gone by. Defense stocks on the move, on the hope that there will be more export orders for defense, given the fact that Trump has been talking about more export of defense components from India, and there will likely be more tariffs on pharma, autos, and perhaps even IT stocks. So that is where most of the weakness was. You had some good gains in PSU banks, in real estate, tourism, and metals and public sector enterprise space also. So given this today's move, a significant number of sectors have uh, reduced the losses in the last 1 week. Defense is still in minus 4.9% loss, but this is also the biggest gainer for the day. In the capital market space, BSC jumping 9% in one session. So BSC has been extremely strong. BSC is, I think, hardly 10 or 12% off its all-time high. So BSC has been quite a remarkable story. KFinTech, 360, Angel One, Nuvama, Multi Commodity Exchange, all doing quite well, 3% to 6% up. This sector seems like coming back up very, very rapidly. Now let's get into the topic of the day. Are you avoiding this perfect serial trap? Is the topic. So let's look at the mutual fund inflows, how they have performed so far in October. Before this market fall started, you were seeing these kind of headlines where mutual fund inflows have doubled in 2024. Record SIPs coming in. 43 months consecutive inflows growth, and everything was hunky dory at that point of time. FII data also, sporadic buying figures. These are monthly data of the last 4 odd years, but on average mostly selling. DIIs, however, continuously buying, hardly any selling, or low buying months. In fact, from August 23, they have been continuous buying in a big way going forward. When we look at the two numbers, DIIs and FII figures, 8.2 lakh crores taken out by FIIs and 11.9 lakh crores pumped in by DIIs since Feb of 2021. So in 4 years, approximately almost 3.5 to 4 lakh crores additional has been put into the markets by domestic institutions. Yet the FII figure continues to overshadow the domestic figures here. Now, the problem here is how much of these inflows are translating into meaningful outcomes on the indices, etc. etc. So, we look at one ratio called the SIP stoppage ratio today. Uh, the data for the month of January is showing that SIP stoppage ratio is surging, and it has jumped from 60% to 80% to 109%. So let's first understand what is this SIP stoppage ratio. So SIP stoppage ratio is the number of SIPs stopped divided by the number of SIPs started. So if in any 1 month 50 lakh SIPs have started, but maybe 60 lakh SIPs have stopped, it would mean that the stoppage ratio is 120% for that matter. Now, so far the SIP stoppage ratio has been in 50-60% kind of range, which means that the number of SIPs stopped was much lower than the number of SIPs that were starting. And that is basically telling you that more and more SIPs are starting towards the market, and there is confidence in the market. But now what is happening is, and this is a infographic from the Mint, uh, that since April 2024, where the outstanding SIP accounts for 8.7 crores and a AUM of 11 trillion rupees, The SIP stoppage ratio was 52%. And then in May, just before the June outcome of the elections, if you remember now, a lot of people actually stopped their SIPs, and possibly moved out of the markets, or maybe moved into some defensive strategy. So this ratio really went up in May, but then from June onwards, again the ratio collapsed to near 50s, 60s, and from November onwards, it is very, very clearly proportional to the market moves. That since November, you know that the markets have been on a downswing, and from there itself you can see that the SIP stoppage ratio has been going up from 60s to 70, 79, 83, and for January it has been 109. So essentially, meaning that more and more people are stopping their SIPs versus starting new ones. Some of these are also rotational in nature, where you stop one scheme but you start another one. But net net, if you see, in terms of the number of SIPs, that is something that is going up in terms of stoppage. Now, the SIP AUM has not really dropped off, which is a sort of a positive sign, where despite the stoppages, the net amount of money coming in, that has not really dropped off the cliff. It is down by maybe like 3-4% from its highs, but that is not significant. However, the number of SIP starts and stops are certainly quite stark. So this could mean basically two things: that either investors are squaring off their investments too early, or they are constantly jumping from one trend to the other. So what's the next sort of hot thing in the market? Let's go there, or what the distributor or your bank relationship manager is able to sell to you, because their job is to sell you the fund which is has the hottest returns in the last 1 year or 2 years, and the ones probably also giving them the most commission. So you can see it very, very clearly here. Total inflows of 1.5 lakh crores in calendar 24 have been into sectoral or thematic funds. So whether defense was running, or earlier than that PSU banks were running. Almost 40% of the market is going into sectoral or thematic funds, which clearly is a indication that this is being thrust down people's throat, either by sellers, or distributors, bank managers, or people are just chasing very recent returns in specific schemes, or specific themes, and that is what is driving those uh, SIPs towards those thematic funds. So let's also now, in context, look at historical perspective of the Magellan Fund. I've talked about this fund many times, but it is good to talk about this in this context as well, where the Magellan Fund was managed by Peter Lynch, one of the greatest greats of fund management of all times, from 1977 to 1990. And you can read his book; it's an amazing book. uh, and he delivered an astonishing annualized return of 29% per year for those 13 odd years. And the fund size grew from $18 million to $14 billion in those 13 years, one of the most successful funds in the history of mutual funds of the world. Now, the irony here is that despite these stellar returns, imagine a mutual fund which is giving a 29% CAGR over 13 years. The average investor in the fund actually lost money, or at least made much less than the fund's official returns. Now, you can say, how can that happen? Now, it would always happen, because people will not simply follow that fund for 5 years, 7 years, 10 years. But rather, whenever there was a huge run up in the fund because of a good market, it is at that point that most investors would come in, and then whenever in 1 or 2 years there was a bad performance, people would move out at that time. So the average investor never sort of made money in the fund, despite the fund doing really well. So somebody who came in from the start to end really made a lot of money, but somebody who just tried to keep timing the entry of his investments in and out did not make any money. So the whole idea being that this SIP closure or SIP stoppage that is happening is potentially the same activity that is happening, that people are jumping from one ship to the other, from one theme to the other, from one market cap to the other, without realizing that they need to stay invested for a long period of time within each of those segments to really go through that market cycle. So that lack of patience to sit through that market cycle is the biggest reason why most investors will not make money in the markets. They will keep entering at peaks, keep exiting during corrections, be the sheep, at the bottom, and be the pig at the top, and absolutely get slaughtered. So performance chasing instead of sticking to a plan is the core, sort of, you can say, the serial trap that a lot of folks are trapped in, maybe because of poor, you can say, guidance by others, but then also because a lot of folks are not really taking it upon themselves to really figure out what is happening. Just investing on somebody else's advice, in terms of, you have to see what is their sort of incentive to sell you those particular themes. Is it commissions, is it something else, and what are you getting out of it is something that you need to really open up your eyes to. So this is something that is very, very simple. However, very few people are able to sit through that pain and have that long term plan roll out, and give them so much benefit. So let me know in the comments, how do you choose your investment vehicle, based on what philosophy, returns, other factors, and how are you managing to sit through this pain, and not jumping from one ship to the other, and what has been your journey around that. Do write in the comments, and thank you so much for watching. Do subscribe to the channel, and do like and share these videos. Thank you.